Welcome back here with Halftime Report. Just a couple of updates on the market. Some of the oil marketing company stocks have gotten a little wobbly in the last few minutes. So there is some profit taking that's setting in on a BPCL or on an IOC as well for what it's worth. But the real drag really is coming in from lever. Lever is down, about 0.5% at the moment. It's preventing any kind of a wider recovery in the market. So that's where sort of things are. That's how things are stacking up. Those are the major trends that we have at the moment. And Reliance itself, of course, continues to be a big mover on the way down. So a bit of a party spoiler, so to speak. But anyhow, speaking of party spoilers, there's a lot, I think, that the promoters of Kotak Mahindra Bank have to think about because it is D-Day. It is the 31st of December. And apart from planning their New Year bash, Mr. Uday Kotak has to see how things play out with respect to the Reserve Bank of India as far as the deadline is concerned and the reduction in the promoter's stake. So let's get in, Lata, to understand how things are playing out at the moment. Lata?
Well, it is D-Day, and in this case, it is called Deadline Day because the deadline to bring down the promoter's stake, which Kotak Mahindra Bank undertook, has not been met. So this is not an Uday Kotak issue. It's a Kotak Mahindra Bank issue because promoters, as the bank, as people close to the bank tried to tell us, are not regulated by the Reserve Bank. It is the bank which is regulated. So the bank is now not met the deadline. Of course, it has taken the Reserve Bank to court, and the court did not stay the deadline. The court also did not stay the penalty. It was specifically asked by the Kotak Council, can you stay the penalty till the case is heard? The court said, I will say no such thing. And it was the RBI Council who proactively said RBI is the responsible institution. That means nothing. I mean, a responsible institution also has to penalize for reasons of violation. And that's my next point. What can be the penalty? All we have by way of precedence is that in the Bandhan Bank case, because Bandhan's non-operative holding company did not meet the RBI reduction of promoter stake norms, the bank was not allowed to increase the salary of its MD nor open fresh branches. But there is nothing in the law that says that the penalty has to be the same. If it is the same penalty, actually Kotak may not be immediately hurt because I don't think Kotak Mahindra Bank's managing director really cares to increase his salary at the moment. More branches, yes, could be a bit of a drag. But, Kotak is actually wanting to grow inorganically, and further branches can still be opened with the permission of the regulator. But really, what can be the penalty, and whether the penalty will be given now or whether the bank, the Reserve Bank, that is, will wait for the next hearing. And if the next hearing merely adjourns it to the next one, then how long can the regulator wait? And the regulator's biggest problem will be what I see as inequality. If you have punished Bandhan Bank, and if because you have that law in the books, Yes and IndusInd and other banks have brought their stake down in various previous occasions, can the regulator not mete out any punishment for one bank which has not obeyed the law? It's extremely awkward for the Reserve Bank not to take any action for an indefinite period of time till the entire case is heard. Because specifically the court has said, I will not stay the deadline and I will not put a stopper to penalty. Then the regulator's case becomes very difficult to defend if he does not react. Separately, it is important that, you have to debate the issue itself of widely held ownership. There is a lot of merit when the Reserve Bank says that big institutions like banks, which take a lot of money from depositors, should be widely held, cannot be held narrowly or by a single group. At the same time, widely held banks also have had problems, and narrowly held banks like Kotak have not fallen into problems. So it may merit a debate. That long-term argument that you have to debate the ownership of private banks is taken. But an inequality of treatment between various banks is also something which the Reserve Bank will not be seen as responsible for. To be held up for not treating others equally is something the regulator will not want to see. And therefore, this is going to be an overhang till the RBI says this is the penalty, or the RBI specifically says that it is not penalizing, this overhang is likely to continue.
So, ma'am, could this mean a 5 p.m. press release for Lata ma'am from the Reserve Bank of India on the 31st of December on this matter?
I don't know what the Reserve Bank might do. I mean, they can always do something even later on, waiting to think through. After all, we have a new man at the helm, and his other pressing problems are many more. Absolutely. Is there a debt market issue? Is there liquidity in the system? Do NBFCs require special liquidity because there's so much of a political pressure as well? How will farm loan waivers pay out? Is there a separate package needed for MSME? These are clearly more pressing issues for a man who is barely 3 weeks in the office, or even less than 3 weeks. So, I mean, a postponement of the penalty up to the next hearing of the Supreme Court is, fairly in line with what you might expect from the court. So, I am hoping that party pooper doesn't happen.
Okay, all right. Thanks so much, Dada, for joining in and explaining that so clearly to all of us. Well, time to get you some exclusive market opinion. Then earlier today, we spoke to a veteran of the market, Ramdev Agarwal of Motilal Oswal, on the year gone by and what lies ahead for the market in 2019. Let's listen in to what he had to tell us.
If you look a little longer, I mean, this 1 year thing, you don't know. I mean, you may have another year of correction because in the past, 2 to 3 years have been the real norm. I mean, from the highs, typically it takes 2-3 years for it to fully correct. So maybe another year of correction, or it is half a year of correction. But if you look at 5 years, I mean, 5 years about 12%, 11.5%, 12% kind of compounded, which is what, kind of an investor should give more credence to. Can we do another 11-12% in next 5 years compounded? I mean, there will be a lot of upheavals in next year also, and a lot of positivity also. So, it is very difficult to say how, and on top of it, oil may go to 85 and still the index may is still go to 13-14,000. So, there is no correlation between one factor with other. But over 5 years period or 7 years period, you see typically some sanity comes in the market where earnings, P multiples, they come to play.
All the earnings reports seem to be pointing out that one of the reasons why earnings were flat, your famous bar chart from 2013 to FY18, the flatness was because of the financial stocks and the huge provisioning that they had to make. Now that's over. I mean, it's very obvious from the SBI results, I mean, the whole host of results, that the bulk of the provisioning is over, and now operating profit will come into net profit. So, given that, don't you think earnings are all set to fire up? If you were a betting man, what is the bet that earnings will fire in FY20?
It should, I mean, I don't know 18, 19, but 19 or something, but it should fire. Probability that in next 5 years you will have a earnings surge, like particularly coming. One is the consumption, second is the capex. So the earnings come from these two fundamentally large segments of this thing. So consumption side, nobody has ever disappointed. Here, apart from the banks, which kind of had our corporate loan banks have disappointed. And that is also linked to the capex boom. So my sense is that the economy after 10 years, finally, somewhere along the line, will see a surge in the capex. And that capex will lead to earnings growth for a lot of companies. And I think one more pain point which is right now passing through the real estate, which is largest possible industry, maybe not so much incorporated, but otherwise for the jobs, for the real good, feel good, that real estate thing is still down. But with the RERA now biting in, my sense is the sense of discipline will come in next 1 or 2 years. It will find its own momentum, consolidation will happen, and because house demand is not going to go down. So I think we'll see in next 1-2 years better things prevailing in the economy.
In terms of portfolio positioning, this year was about defensives. Are we moving into a phase where you want to add some beta in the portfolio?
I don't know how to think about this beta. This thing, we always want to make money, Yeah. So yes, you make some changes. I mean, as I said, capex cycle is reviving. Now, when will it become very vigorous? That nobody can calibrate. Whether like oil is already down, and if it stays around 60, give and take $3-4, and then interest rate finally follows. I mean, how long MPC or anybody can keep it high? So either they increase the inflation rate or they have to cut the rates. I think taking the inflation, finding some via media would be better thing, but it's a complex situation. I don't know. But I think we're looking at lower interest rate scenario. So these 2-3 things start falling in place. And no more, substantial change in the system. Like we went through 2-3 major changes like demonetization, GST. So those kind of disruptive changes, which are positive, if it is not there, then economy finds its momentum.
If we are in the cusp of that, you said 10 years no capex, and then last quarter we saw L&T announce good orders and Cummins and ABB and all those guys announcing decent orders. In that case, would you say that irrespective of the political turnout, we have a good thing going in terms of capex cycle? How disturbing is or how important is the political result?
It is important because a lot of things have happened in the last 5 years, and we hope that it continues. The changes, the pace of change, the direction of change basically must continue.
You do have stocks like Maruti, Eicher, etc. in your portfolio, but I just wanted to draw your attention to one of the dealer checks we did on Friday, where they spoke about inventory levels as high as 10 to 12 weeks, and demand very poor, etc. Do you think now is the time to buy the auto stocks that you like, the leaders in this space, or do you think you'll get better levels over the next, say, 6, 8, 10 months?
Yeah, if you believe in the franchise, if the future of the companies are intact, but the present is kind of slightly challenged, no business goes in a straight line. So the time to buy is when there's a pessimism on the street. We know that 5 years henceforth what is going to happen to whatever names you are saying, but we don't know. Right now things are not looking that rosy. This is the time to go and hit the bargain.
Okay, so that's the eternal optimist Ramdeo Agrawal saying that 2019 should be a better year for equities in 2018.